Right before we start this panel, which is, the title is Financing Liquidity Surfaces, I'm not sure if I should put a question mark after liquidity surfaces. But I want to thank, before we start in, I want to thank the team who has put the conference together, my fellow co-chairs, Rob Blumenthal, Richard Kessler, and Michael Stoller. Thank the team at NYU, under Dean Stuckey, and very much thank Jessica Estrada Watson for her efforts in putting this together and did a wonderful job. First, this has been a difficult 12 months since the last conference. Probably many of us didn't appreciate how bad things were going to get, and obviously we're trying to get a handle on what 2010 and beyond will bring, and an important program, an important component of that will be, is there going to be, what kind of debt is going to be available for real estate transactions? More so, and we'll talk about this in a minute as a question to the panel, there's probably, and it's been mentioned, there's probably close to, depending on the source, 1.3 to 1.8 trillion dollars of loans maturing in 2010, 2011, and 2012. Obviously, with cap rates and property values cap rates going up, prices going down, how will these refinancing get established? And finally, we'll have the panel talk about something that the equity panel touched upon, and that's the new TALF program. And this one new issue that came out, did it actually work? And I think we have some very good people here who will give you some insights into that. And finally, we talk about the guidance of the Fed and the guidance of the FDIC to the banks in terms of, this whole idea of pretend and extend. Obviously, the current state of the debt capital markets, credit markets can be, need to be looked at. We'd like to know what your institutions, how you're looking at that, and where you are in terms of your view on, are you lending, how much money are you lending, and are you in the market? So, Mark, why don't we start and just go straight across? Mark, Well,
I think the debt capital markets in general are pretty strong right now. I mean, you see corporate issuance every day, high yield issuance. One of the things that's very important, I think, now is liquidity for investors. And I think if you have a liquid deal, the securities that can trade, you actually see good liquidity and actually good execution in the debt markets. I think that we have struggled over the past year in terms of making new loans. I think we've been managing our existing portfolio. That's been a big part of what we're doing over the past year. We've been trying to make new loans. We haven't found the economics there that would cause us to commit to a lot of things over the past year, although we're getting a lot closer than we were in the spring.
We have I'd say a cautious view, not so much skeptical as cautious on how well we're climbing out of this illiquidity. Among the life companies, among our peers, there is activity. We've been lending this year consistently through the year. We'll probably put out, $1 billion, $1.5 billion this year, which is well inside of where we were a few years ago. But, and it's not just refinances, it's also, net new business with in many cases, new borrowers or, expanding in markets where we're somewhat underweighted. So we are active. We have an $18 billion whole loan portfolio, about a similar size exposure in CMBS. So one of the issues we look at is our overall CRE, commercial real estate related exposure to total AUM, assets under management. And we're also looking at relative value. You've got among the money managers, there's a fierce search for incremental yield. And, some would argue that, the high yield sector's pretty much run its course in terms of, we think, tightening and opportunity. Corporate bonds are probably in the seventh inning. So, on its surface, mortgages look like they bring a decent relative value proposition. But of course, spreads have come in appreciably even this year, and are continuing in some ways to do so. So we're cautiously in the market, but I suspect we'll do a similar amount next year in terms of net new lending.
I would say at CIBC, we would be cautious looking at the market. We are selectively making new loans to clients or to potential new clients. The issue we're finding, it's very hard to find clients, especially if they've been a experienced player in the market, that do not have loans coming due a couple of years down the road. So it's very hard to underwrite new clients coming in that are not, major clients of ours. We also think, with the CMBS market down, bar the DDR TAV CMBS deal done a couple of weeks ago, we think a market will emerge for mortgages, especially the CMBS side. We think funds and mortgage REITs and specialty finance companies will play a larger role in that going forward, and we're in the process of raising a debt fund right now. We think there will be a lot more of that in the future, but selectively we are lending, and if the credit is right and the borrower is right, we have a good appetite for new quality loans.
I think the picture for new lending is quite different than it was just 6 months ago. 6 months ago, all the debt markets were in distress. David alluded to the recovery that's taken place, but just to sort of put a punctuation mark on that, the high-grade debt market, most insurance companies have about 90% of our portfolio in fixed income. The high-grade debt market yields are now under 5%. And so doing conservatively underwritten whole loans, north of 6, looks pretty attractive. And so what we see is ourselves and most insurance companies are in the market looking for loans, and there's just a very few transactions out there. The reason for that is deleveraging, which is going to take a long time, as the earlier panel alluded to. So we've done about $5 billion in lending this year. Almost 2/3 of that is Fannie Mae, Freddie Mac, FHA, DUS lending, where that's sort of the one place where there's been attractive capital all year, and the other third is on portfolio. In the next year, we'd like to do about $8 billion in lending. I think it's going to be hard to find the transactions.
John?
We are primarily a capital markets lender, and when we think of the capital markets, it really sort of falls in three categories. It's both Fannie and Freddie on the multifamily side, which we've been very active in all year, and we'll probably do between $5 and $6 billion this year in that sector. The second market is the bank market, which is primarily shuttered. It's not open, and so we're not seeing much in the way of loans that we can syndicate to the market. And then there's the CMBS market. We've been quoting loans for the CMBS market most of the year. I will tell you that there's a big difference between what we thought would clear the market and what borrowers can afford to pay or willing to pay. Clearly, the deleveraging has to happen in order to clear today's market. And so while spreads have probably from, I would say, mid-year have been cut in half, we're now getting at a point where we're within striking distance of actually being able to make some loans that will actually clear the capital markets. So we're anticipating closing a few loans between now and the end of the year. They're committed, and we're closing, and it's kind of a good feeling. And again, we'd like to restart the CMBS market, which has been essentially shut for the past 16, 17 months.
At MetLife, somewhat similar to the comments that Dave made, we are actively in the market for reasons of relative value, as has been described, and also just really the practical reason that at this part of the cycle, it's a very safe time to be investing and putting out debt capital with conservative underwriting and the valuation declines that we've seen to date. It's really pretty hard to make a mistake. Unlike 2006 and 2007, when it was very easy to make a mistake. So our view is actually bullish as it relates to putting money out in commercial mortgages, and we'll do about $4 billion of volume this year. Probably 60% of that is refinances of existing loans. We're seeing much less roll-off of our portfolio than we typically have seen in the past. Next year, our goal is about $6.5 billion, which again, if you think about the decline in values we've seen, that's it's a significant volume. At our peak, we were doing about $10 billion of volume a year. It's kind of an equivalent amount of transaction activity. I am concerned that we may not be able to find the transactions to hit those numbers, but we have the capital available.